Welcome to 8 Quanta Library content. In today's video, we'll take a closer look at the general ledger impacts throughout the entire procurement-to-payment process in NetSuite. From creating purchase orders to making payments, we'll break down each step so you can clearly understand how transactions flow into your financials. Purchase order PO creation. When we create a purchase order, it serves as an authorization to procure goods or services from a vendor. Purchase orders are non-posting transactions. This means they do not affect the general ledger, GL, or financial reports. The PO simply reserves the intent to purchase, but does not represent an actual financial transaction yet. Let's move on to item receipt, receiving the purchase order. Once goods or services are delivered, we record an item receipt in NetSuite. At this stage, the system recognizes the receipt of goods into inventory, even though the vendor bill has not yet arrived. GL impact will be a debit inventory account set on the item record. This increases asset value since goods are now on hand. Credit, accrued expenses, or received not billed. This records a temporary liability since the vendor has not billed yet. This ensures that inventory valuation is accurate as soon as goods are received, regardless of billing timing. Vendor bill creation. When the vendor submits their bill, we record it as a vendor bill in NetSuite. This step recognizes the liability to the vendor for the received goods or services. GL impact. Debit, accrued expenses. This reverses the temporary liability created at receipt. Credit, accounts payable. This creates the actual liability owed to the vendor. This shifts the liability from temporary accrued expenses to the formal accounts payable account until payment is made. Vendor payment. GL impact. Debit, accounts payable to reduce the liability since payment is made. Credit, bank or cash account to reduces company cash balance. If payment discounts apply, e.g., early payment terms, the system can automatically record a credit to discount income account for the amount saved due to early payment. This closes out the liability and reflects the payment in the financial records. And that wraps up this video. If you found it helpful, don't forget to like, share, and subscribe for more content. Thanks for watching, and see you in the next one.